Protecting your investments during a recession while still aiming for profit is a balancing act that requires discipline, insight, and a willingness to adapt. Economic downturns can be unsettling, but they are also periods of opportunity for those who prepare thoughtfully. Let's walk through a comprehensive strategy to safeguard your assets and position yourself for potential gains, even as markets turn volatile. The first step is to shift your focus toward defensive assets. These are the financial instruments and sectors that tend to weather economic storms more reliably. Dividend-paying stocks are a classic example. Companies in sectors like utilities, healthcare, and consumer staples often continue to generate steady cash flow even when the economy slows, allowing them to maintain or even increase their dividend payouts. These dividends can provide a stable source of income, cushioning your portfolio against falling share prices. Bonds, particularly U.S. Treasuries and high-grade corporate bonds, are another cornerstone of a defensive strategy. Treasuries are backed by the full faith and credit of the U.S. government, making them among the safest investments available. High-grade corporate bonds, issued by financially sound companies, also tend to hold up well in recessions. While their returns may be modest, their stability can help offset losses elsewhere in your portfolio. Precious metals, especially gold, have long been seen as a hedge against uncertainty and inflation. During times of economic stress, investors often flock to gold, driving up its price. Allocating a portion of your portfolio to gold or other precious metals can provide a valuable counterbalance to riskier assets. Cash and cash equivalents, such as high-yield savings accounts and money market funds, might seem unexciting, but their importance cannot be overstated. Cash provides flexibility, allowing you to act quickly if attractive opportunities arise. It also acts as a buffer, reducing the overall volatility of your portfolio. While reinforcing your defensive positions, it's equally important to reduce your exposure to high-risk assets. Speculative technology stocks, small-cap companies, and businesses with heavy debt burdens are often hit hardest during recessions. These companies may struggle to access credit, face declining demand, or simply lack the resilience to survive a prolonged downturn. Reassess your holdings in these areas and consider trimming positions that carry outsized risk. Cryptocurrencies and emerging market stocks are also vulnerable during global downturns. While they can offer high returns, their volatility and sensitivity to economic shocks make them risky bets when the outlook is uncertain. If you hold these assets, evaluate your risk tolerance and consider reducing your exposure until conditions stabilize. Value investing becomes especially relevant during recessions. This approach, championed by Warren Buffett and other legendary investors, involves seeking out strong companies trading below their intrinsic value. Focus on businesses with durable competitive advantages, what Buffett calls economic moats, as well as robust cash flows and manageable debt levels. These companies are more likely to survive tough times and emerge stronger when the economy recovers. The concept of a margin of safety is crucial. Don't overpay for stocks, no matter how attractive they seem. By buying well below a company's estimated true value, you give yourself a cushion against further declines and increase your potential upside when the market rebounds. Dollar cost averaging, or DCA, is a disciplined investing strategy that can help you navigate volatile markets. By investing a fixed amount at regular intervals, regardless of market conditions, you avoid the temptation to time the market, which is notoriously difficult even for professionals. Over time, this approach can lower your average cost per share and help you benefit from market volatility. Diversification remains one of the most effective ways to manage risk. Spread your investments across different sectors, such as technology, healthcare, energy, and consumer goods. This reduces the impact if any one sector is particularly hard hit. International exposure can also enhance diversification, though it's important to be selective. Some economies may be more vulnerable to a global recession than others, so focus on regions with strong fundamentals and stable outlooks. Bear markets are characterized by sharp declines, but they are also punctuated by short-term rallies, periods when prices rebound temporarily before resuming their downward trend. Savvy investors can take advantage of these bear market rallies through cautious swing trading, provided they have the experience and discipline to manage the risks. Inverse ETFs, which move in the opposite direction of the market, can be used as hedges, but they are complex instruments and should only be used by those who fully understand them. Similarly, option strategies can offer protection or speculative opportunities, but they require skill and careful risk management. Certain sectors may benefit from government stimulus or changing consumer behavior during recessions. Infrastructure, for example, often receives increased investment as governments seek to boost economic activity. Identifying and investing in these sectors can provide opportunities for profit even in challenging times. Alternative investments can further diversify your portfolio and provide additional sources of income. Real estate, particularly rental properties in stable markets, can generate steady cash flow and may even appreciate in value over time. Real estate investment trusts, or REITs, offer exposure to real estate without the need to directly own property, and some REITs specialize in sectors that are relatively recession-proof, such as healthcare or essential retail. Commodities, like oil and agricultural products, can also play a role, depending on global supply and demand dynamics. However, commodities can be volatile, so it's important to understand the factors driving their prices and to size your positions appropriately. Liquidity is a crucial consideration during recessions. Keeping 10 to 30% of your portfolio in cash or cash equivalents gives you the flexibility to take advantage of opportunities as they arise, whether it's buying quality stocks at bargain prices or responding to changing market conditions. At the same time, it's important to remain patient. Recessions are temporary, and markets often begin to recover before the broader economy does. Avoid the temptation to panic sell during downturns. Instead, focus on your long-term strategy and be ready to act when conditions improve. Certain sectors have historically proven to be more resilient during recessions. Healthcare is a prime example. Demand for medical services and products remains steady regardless of economic conditions. Utilities, which provide essential services like electricity and water, also tend to be stable performers. Discount retailers, such as Walmart and Dollar Tree, often see increased business as consumers become more price-conscious. Basic consumer goods, items like toothpaste, food, and household supplies, are necessities that people continue to buy even when money is tight. By focusing your investments in these recession-proof sectors, you can further insulate your portfolio from the worst effects of an economic downturn. Risk management should be at the core of your approach. Regularly review your portfolio to ensure it aligns with your goals, risk tolerance, and time horizon. Rebalance as needed to maintain your desired asset allocation, and don't be afraid to make changes if your circumstances or the broader economic environment shift. Staying informed is another key to success. Monitor economic indicators such as unemployment rates, consumer confidence, and corporate earnings. Pay attention to central bank policy, as interest rate changes can have a significant impact on both stocks and bonds. Keep an eye on fiscal policy as well. Government spending and tax decisions can influence the trajectory of the economy and the markets. It's also important to recognize the psychological challenges of investing during a recession. Fear and uncertainty can lead to rash decisions, such as selling at the bottom of the market or abandoning a well-thought-out strategy. Stay disciplined, focus on your long-term objectives, and remember that markets have always recovered from past downturns. If you're new to investing or uncertain about your strategy, consider seeking professional advice. A financial advisor can help you assess your risk tolerance, develop a diversified portfolio, and stay on track during turbulent times. In summary, protecting your investments during a recession while aiming for profit involves a combination of defensive positioning, opportunistic investing, and careful risk management. Shift toward assets that offer stability and income, reduce exposure to high-risk sectors, and look for value in strong companies trading at attractive prices. Use dollar-cost averaging to navigate volatility, diversify across sectors and geographies, and be prepared to act on opportunities that arise during bear market rallies. Consider alternative investments and maintain sufficient liquidity to stay flexible. Focus on recession-resistant sectors. Manage your risk proactively and keep a long-term perspective. By following these principles, you can not only protect your wealth during challenging times, but also position yourself to benefit when the recovery begins. Remember, every recession eventually gives way to a new period of growth. Those who prepare wisely and stay disciplined are often best placed to prosper when the tide turns.